Word on the skips. All right. The recording should have started. Welcome, welcome. Happy Monday. Thank you guys for joining us. So today we're kind of doing a round robin and we're going to share some frequently asked questions and what our answers are to them. And if something sounds interesting to you, feel free to reach out to us offline and we're happy to elaborate. This is meant to be really quick just to get some of these answered for you and keep us within our half-hour time frame. Because obviously we chose 25 questions, so there's not much time for elaboration here. All right, Sam is going to lead us off here. She's going to be asking us the questions and then we'll be going around and answering them for you. Take it away, Sam.
All right, sounds good. So the first question that we are going to start with is what loan programs do we offer?
And that is to me. I am Alicia and wanted to let everyone know that we do the regular Fannie Mae Freddie Mac programs. We do the first time homebuyer programs with as little as 3% down, the FHA government programs with as little as 3.5% down. And we go up to jumbo programs that are millions of dollars that you can finance. We also offer specialty government programs like the USDA, which is a rural housing program with 0% down, VA options also with 0% down. And we have a lot of specialties out there that are the condos that are not, they call them non-warrantable, that can't get normal financing. A condotel, a condo association that has a management office that they rent the condos. We also have what's called an ITIN product, which is for people who are not U.S. citizens. We have foreign national programs, which are people who are here on work visas or coming to coming to our country. We also have some real great investor programs, like a bank statement program, where we look at your a DSCR program is specifically for investors. And that is if the property, if you put down a minimum of 20% and they look at the payment of the property, and if the rent covers the payment, you get the loan. And the other one is that bank statement that I mentioned earlier, and that is for primary homes, for second homes or investments. It's really a great option for self-employed people because it looks at your deposits in your bank statements rather than your tax return.
Yeah, that's
Yes, we do
fantastic.
offer
And just so everyone knows who's watching, we're going to be going deep into the specific programs on additional trainings. So the things like the non-traditional, my dog's in the background, non-traditional things like the bond programs, like we'll be going deep specifically into each program on other calls. So if there's anything you ever want to hear more information on, just let us know.
Yeah, perfect. All right. Another big question that we get is, and this one's for Kelly. So what affects the interest rates?
Oh, I love this question. It's such a loaded question because a lot of people think they know the answer to it, but don't actually know the answer to it. So, what impacts your interest rate? So many things. So, the first thing, truthfully, is the loan program. So, different loan programs and different products have different interest rates. Some programs have set interest rates, like here in Connecticut, we have the Connecticut Housing and Finance Authority loan. That's a set interest rate set by CHFA every day. But different loan programs have different interest rates. Now, what for you personally impacts your interest rate? Well, the number one item is credit score. Number two is loan to value. So how much money are you putting down on the property? Number three is how big or how small your loan is. Okay, so really big loans sometimes have different interest rates than medium-sized or smaller loans. But there's a lot of different things that come into play in interest rate. And really, if you see rates quoted online or you have a friend who's saying, oh, well, that seems different than my interest rate, the answer is generally not as simple as people think it's going to be. They think they can kind of go online, look at an interest rate, and that's going to be what they're going to get. But really, it's your full profile that's coming into play on what that interest rate is. It's all the different pieces of your loan that come together that determine your rate. So it's not always the simplest answer, but it's something that your loan officer can definitely help you figure out early on in the process.
Perfect. I think that was a great explanation on what goes into the rates. And our next question is, do non-first-time homebuyers are required to put 20% down? Bree, I think this would be a good one for you.
So no, that's definitely a misconception that on a conventional loan that you're required to have 20% down. I know you said non-first-time home buyers. Well, we have programs that are conventional financing that has down payment assistance, so they could actually do it with 100% financing. But a typical first-time home buyer program is 3%. and a subsequent purchase is 5% down. Now, there are situations where you could do 3% down as a non-first time home buyer if you fit into certain income programs. So it's definitely you do not need 20% down. You could definitely do a conventional loan as a non-first time home buyer with possibly as little as 3%, 3 to 5% down.
Great, that's perfect. And Bree, again, another question that you might be able to answer. What are special programs we have for our veterans and active military?
Okay, so we have VA mortgages, and I do a lot of them. My whole family's prior military. I have a brother that's still in. And what that program is with obtaining what's called your certificate of eligibility from the VA, which I usually help you obtain, you could do as little as 0% down on that program. There's also no monthly private mortgage insurance. There isn't, depending on if you are receiving disability or not, they also don't charge you there's an upfront PMI fee that's being charged. So the other thing is too, with our mass housing program, say that for whatever reason you have maybe some money being put down and maybe a conventional option is better for you. Mass housing also offers at this time $2,500 credit towards your closing costs. So for prior military, plus internally, we usually give some discounts as well. So that's definitely something if you're if you're active military or prior military, you definitely want to reach out and make sure you have someone that actually knows VA loans, because there's a lot of little nuances that people don't know about. It could really delay closing.
That's awesome. I think that's great. And kind of piggybacking off of the 0% or the special programs, Katie, do you know, do we offer any other 0% down programs?
Why, yes, we do, and we love using them. I love personally helping people with the down payment using these programs so they can keep money in their accounts for things like reserves or something they weren't expecting, or fun stuff like decorating your new home. So we do offer USDA loans, which are available in rural areas. So depending on where you're helping your buyer find a home, we offer state bonds programs in Massachusetts, New Hampshire, Rhode Island, Connecticut, Florida, and other places. Those are just the ones I'm aware of. So we can probably connect you with state bonds programs depending on where your clients are looking as well. We also have a down payment assistance associated with FHA, which can help non-first time buyers. And a lot of people don't realize this option exists. We're using it a lot right now. Especially a lot of people have really racked up some debt as of lately. And so we're utilizing the sale of their home to put them in a better long-term position by paying down their debt. And they're leveraging the 0% down program and just able to come up with some closing costs. So it allows them to get into something they normally wouldn't be otherwise able to get into. So we love these programs. We offer a lot of different options for first time and non-first time buyers. And we would love to talk to you more about them. And we'll be doing the classes, like I said, about them as well.
Yeah, that's awesome. Alicia, what
Yes.
are our credit score requirements?
That's a loaded question. No, it's not. It really the minimum that we can assist you with is a 580 credit score.
Yeah.
And 580 is for FHA government financing. They'll allow you to do that. 620 is the minimum to do the conventional financing. But just so you know, the higher your credit score is, the better you are, and the better odds you are of having what's called AUS. So if your credit score is a 580, yes, you do qualify, but we also need to be able to get you approved by FHA or Fannie Mae or Freddie Mac. And the higher your score is, the better profile you have to be approved for the loan.
I want to add something there too. So there's been one recent change with Fannie Mae does allow a blended score. So if you have a borrower with a lower credit score, like a 580, and then the co-borrower has an 800 credit score, they will actually take an average. And I have seen some approvals. They typically want to see money down, but in the past, that was a hard no, it would stop it. And now it's just going to cost you a lot more. Also, if you have a fair amount of money down, I believe it's 10% or more, we can do FHA down to 500. That being said, we still have to get an approval our end. So we're not really seeing it very often, but it is possible. I do that a lot with interfamily sales with someone with a lower credit score, where they leverage that equity as the down payment. And I have done like a 507 before for that specific program. So it's very specific, but if someone is having credit challenges, just let us know and we can work with them to try to build it up to whatever program they're eligible for too.
Yeah, definitely. I agree with that. You want some good compensating factors if you have a lower score, and that's what we're seeing. So the better other factors you have, lower debt to income and stuff like that, and higher down payment, that definitely will help you guys. The next question that we commonly get would be for Katie. What happens if a borrower has a low credit score, past bankruptcies, or foreclosure in their past?
Yeah, so I always tell them if your credit score is on the lower side, and basically we're going to look at lending like you would lend a friend. If you knew their credit was awful and they weren't paying their bills, would you want to lend them money? Probably not. So credit history and credit scores is a big piece of what we look at. We want to make sure we're putting ourselves and you in a good long-term position. And that being said, we can still do loans for people who've had a bankruptcy or are even in a Chapter 13 currently. There are non-traditional programs that allow you to do it a lot sooner, but short sale foreclosures, they all have certain time periods that you wait based on the loan program. But I've done one in as little as a year with a non-traditional program. Typically, they want to see 2 or 3 for bankruptcies and 4 for short sales, 7 for foreclosures, or 3 for foreclosures. So like, this is all stuff I'm going through it fast because we want you not to worry about it. We want you to know enough to be dangerous and just send them in the right direction. If someone tells you they have any of these things that have happened, let them know there's hope. And we're willing to work with them and put a plan together while they're waiting for whatever time period it is to pass.
Exactly. That's great. Do we help clients offer appraisal gaps? Katie, I feel like you've dealt with this quite a few times, so I think you'd be great to answer this one.
Yeah, definitely. I think we might have skipped ahead on the question, so I don't know if we should go
Oh,
back.
Did I?
Maybe?
Oh my God, I did. I'm so sorry
That's
about
okay. I
that.
just figured not to get off track.
No, that's totally, yep, that's how, okay. So this will be for Kelly then. How do we assist borrowers who need to improve their credit to qualify for a loan? So what can we do to help?
Great question. So a lot of that really depends on what are we working with here, right? Like what type of credit score and what sort of things are on the credit report. Generally, the first line of defense is your loan officer. So we can often give some pretty great advice kind of right off the jump. And a lot of times we see things like old collection accounts sitting on reports. We might see credit cards with balances that are really high compared to what the limit is, and that will lower your credit score. We might see some old inquiries. So we can usually give some advice kind of right off the jump of, hey, if we take care of A, B, and C, we could see some credit improvement here. We also have networks of credit professionals that we all know as loan officers that we can also refer our clients to. So if somebody needs maybe a little bit more help or maybe a little bit more long-term help, we have credit professionals that we can send them to you. My biggest piece of advice with credit improvement, though, is do not call the like late night TV, credit repair agencies that you see come on. Yeah, those are not great. They're going to take your money and they're not actually going to improve your score. We have some like nonprofit credit improvement agencies, and those will be a little bit better to kind of get you what you need. But there's a lot of ways to fix credit. And what I always tell my clients is that credit is all fixable. It is fixable 100% of the time. What it takes to fix it is time and money. And depending on how much you have of either of those is how quickly you can make it happen, but it is always fixable.
Yeah, no, that's great. And I feel like all of us have helped many clients get their scores up, whether it was like kind of an immediate fix within a couple weeks or within a couple months, but we're here to support our clients. And so if you have clients with bad credit, please have them reach out and we can definitely help them. All right, next question, Bree. Do you need a pre-approval letter for each offer you do make?
No. So don't get me wrong. There are times where there's a situation where the realtor might understand a situation about a specific property and like, listen, I know that your pre-approval says 500,000, but we want to put an offer on this particular property or 450 and not show all our cards. So I do have borrowers that if you have one pre-approval letter, you can typically use that for whatever offer that you're putting in. I do recommend, and within 30 days, I usually have conversations. Like it does look stronger if you have a more recent letter. I also think it looks better if you have the the higher pre-approval amount on there for a house that's in a competitive situation. So that's definitely something that you want to keep in mind. But no, you do not need to have a pre-approval letter issued for every time you put an offer in on a property.
Alrighty. Katie, what do you do to help and offer for your clients to get accepted? Is there something that you do additionally other than just giving them a pre-approval letter and saying, go find a house?
Yeah, yes, definitely. So we want to be involved when our clients are making offers on properties because we like to be proactive and call the list agent before they call us if possible.
Yep.
So we're going to inform them of our process. We're going to let them know, listen, we've already pulled all 3 credit bureaus. We've collected all the documentation. We've run it through an automated underwriting system. These things are very typical for our practice here at Total Mortgage. They are not typical for every lender. You can apply online with Rocket Mortgage and it will spit out an automatic pre-approval, and people are utilizing that to make offers. We want the other side to know that we're comfortable and confident and we're going to get this over the finish line. We also tout our reviews. Total Mortgage has a ton of reviews. I personally have a ton of reviews and I want them to know this many people gave me reviews because I got them to the finish line, and we're going to get this buyer to buy your house and over the finish line as well. And whoever you work with for a lender, I urge you to talk to them about what their process is with the offers because they can help. But you have to use us. I tell agents when we give them their pre-approval letters, listen, we want to be involved, but some of them don't involve me. And so if you're an agent out there, I urge you to involve your lender in your offers to make them as strong as possible, because this is not something special to me or Total Mortgage. Any lender can do this. And it does help. And you have to involve them in order for them to be able to help, if that makes sense.
Yeah, no, absolutely. And I don't know if you want to touch upon this, but for our green light program, like that levels up a lot of our offers. And I've had many offers accepted because of that. Do you want to quickly just touch base
Yeah,
on that?
absolutely. So basically what our green light program is it is a full underwrite by an underwriter. And so I leverage that a fair amount, especially in a newer market because I'm down in Florida now. I want people to know who I am. Up north, we do have a really strong reputation. So depending on the client, if it's an easy client and I'm not worried about anything, I don't always use that program, but it is always available. Especially if you have someone who is selling another home to buy a new one or in a higher price point, we can get them a full loan approval. And basically the commitment letter is subject to the appraisal and the title and the insurance, which we wouldn't have because we don't know the new property yet. So this is a great way for us to use this program and get your client's offer accepted as well. It also makes the process really easy. We say we can close in 21 days, but with a green light, I mean, we're closing in as little as 10 if the seller wants to do that. So it's all based on what the seller wants right now, especially up north.
Exactly. No, it's absolutely great. We love that program. All right, next question. Katie again. Do you help clients offer an appraisal gap? I know you actually taught me years back some different ways that you talk about the appraisal gap, which I think was really great, and I've utilized it. So if you want to kind of go through that and elaborate.
Yeah, so really quick, this is something we're also seeing a lot more up north. In multiple offer situations, the seller wants the highest and best offer, and they want to get the most money for the house. And sometimes that means they want to get paid more than it's actually worth. And I have clients who are willing to do that. So this is just an extra conversation I have with my client, especially ones who are putting a fair amount down. Let's say they're putting 20% down and they have good credit. There are ways we can cover the appraisal gap, meaning whatever it appraises for and whatever you're buying it for, whatever the difference is, without them having to come up with the exact amount of money. So for example, a $20,000 appraisal gap, most lenders, not most lenders, some lenders would think you have to come up with that $20,000 cash. That does not have to be the case. There are ways we can leverage what you're already putting down and the value of the house and add on something like mortgage insurance, or increase the rate a little bit depending on the program and offer the same amount without having to pay that exact difference. So that's something I go over with the client. It's not for something for the agent to be worried about. The agent just needs to know how much of an appraisal gap can they cover. And my buyer knows from talking with me what that means on the lending side.
Yeah, I just did it this weekend and I think it really helped. My client was able to go up a lot more than they thought because they didn't have the cash, but their mortgage insurance went up $20 or something like that.
Yeah, people don't realize, and
Yeah,
I
it's
am
great.
telling them, listen, make no mistake, this means you're paying $20,000 more than the house is worth in the market if that's what the appraisal comes back at. But they don't, it's not that they don't care, it's that they understand it and they're okay with it because
Right.
most people care about the house and the payment.
Exactly.
I have very minimal clients who don't care about the payment. So, but those are things we all pay attention to, you know?
Exactly. So no, that was great. Um, Another common question that we get is how much can my buyer ask for in seller concessions? Alicia, do you want to take this one?
Sure. We were talking earlier about how to buy a home with no money. Some people can come up with the money to put down for the down payment. In reverse, we kind of look at it in a different way that we can get them a second mortgage for the down payment funds, but they need to pay for the closing costs. And the closing costs, a good way of doing that is to be offering as a part of your offer, asking the seller to contribute toward those closing costs. And this way, virtually, sometimes you can do a second mortgage for the down payment. You can get the seller to pay the closing costs. And it's another way of purchasing a home with little to no money out of pocket. With government financing, you're allowed to ask for up to 6% of the purchase price. For conventional financing, it's generally 3%. But if you're putting down more than 5% down, it increases for you. And with VA financing, you're allowed to ask for 4%, which is significant when you're talking about, $300,000 home at 4%. That's $12,000 that you can ask.
Mhm.
And lots of times we'll have the buyer increase say the seller wanted $350,000. We'll have them increase their offer to $362,000 with a $12,000 seller credit. So it still nets the seller what they want and allows the buyer to finance into the loan those closing costs.
That's great. And Bree, I'm going to ask two questions in the appraisal sector. So when is an appraisal ordered?
Mhm.
And then after that, what is our appraisal process?
Okay. So typically the appraisal is ordered, well, how I do it, and I think everybody has a little bit different. I typically wait until after home inspection has been completed and I know that there's no adjustments and I confirm with everybody there's no changes to the purchase and sale because every state's a little bit different. So Massachusetts has an offer and then goes to purchase and sale. There's other states that just go right to purchase and sale, and then they have an addendum to that. So once I know everything has been cleared with home inspection, I typically will order the appraisal up front. Now I'll tell you, we're very lucky because our appraisals are done. We have a panel of appraisers that we're going to say they've been tried and tested and made sure that they're going to get these appraisals done in a timely fashion. So we don't typically get hung up on that. So I order the appraisals in that time frame. And then for government loans, you're going to be a little bit more specific. They do want to see a fully executed purchase and sale agreement for most government loans. But this way we make sure that we didn't miss any seller concessions or adjustments in purchase price or anything like that. So typically once I know the home inspection's cleared and we do have the borrower pay for the appraisal up front. Things like that. Because I always tell people, I'm like, appraisers are very happy that they're getting the work, but they're like, oh, cool, you won the lottery and you're moving to Tahiti. That's amazing. They still want their money. So decide not to buy the house. And then for the appraisal process, we do have, we don't have like an AMC. We don't have an appraisal company that we have to farm out to. We do have a separate appraisal department that handles all of that, and it's all handled in-house. So that means that when they order the appraisal, they monitor when the appraisal's due date is, if there's any hangups, if there's any questions or concerns. So there's direct communication back and forth with all the regulations. We can't have conversations with appraisers, but they make sure that if there's any questions in relation to the transaction that they're asking.
Yeah, no, it's great. And I actually saw a client that was working with someone prior. They had an AMC and the appraisal was just like $400 more than what we normally charge. We just charge what the appraisers get. So that's a really, important thing too. It saves our clients a lot of money.
Absolutely.
And I don't think people realize that too. So
Mhm.
that is great. The next question, next common question that that gets asked is, what is our process in handling loans that require repairs or renovations? And Kelly is the queen of renovations. in my opinion. And so take that one away.
So it really depends on if you know you need renovations before you start home shopping. Like if you're purposely looking for houses with renovation loans, or you find a house that you know is going to need repairs and renovations, or if you don't find out until you're already under contract and maybe you have a home inspection done and repairs are needed. So if you know ahead of time, then we really set your loan up from the get-go to be a renovation or rehab loan. And it's a little bit of a different process, a slightly different loan on our side, but for you as the borrower from the beginning, it looks fairly similar. We just know that we're going to have a special home inspector go into the house instead of just a regular home inspector. You're going to have one of these HUD consultant home inspectors do your home inspection for you. And I generally like to engage contractors very early in that process. So the contractor can come in, we can kind of get an idea like, what is this going to cost us? If you don't know until after you're already under contract for the house, we are working a little bit backwards at that point where maybe you've had a home inspection and you find out, say, septic needs to be replaced. It's a lot of money. You might not want to pay for that out of pocket. At that point, we would sort of flip your loan over to a renovation loan. We would get those contractor quotes and bids and we start the process. You may, if you read about renovation loans online, they sound very, very stressful. They do not have to be. It is more paperwork, but again, to get money to help pay for these renovations, not out of pocket, the paperwork can be well worth it. And Total Mortgage has an amazing team that will really walk you and your contractor through every little piece of it. So it really just depends if we're looking before or after. I would say if you think a rehab house or renovation loan is something in your, you'd be interested in, it might be something kind of in your wheelhouse, it is a great conversation to have with your lender. Now, not all lenders do rehab and renovation loans. So if you are talking to a lender who's like, oh no, you don't want to do that, they're awful, you really may want to stop and ask them, is it because you don't do them? Are you not comfortable with them? You kind of want to challenge it a little bit because they really don't have to be bad. And I actually pick up a lot of renovation loans from realtors who maybe it was with a different loan officer who, lo and behold, we find out they just don't offer them. So they've kind of been steering clients away from it from the get-go, or saying, oh, we had a bad inspection, you got to cancel that deal. No, we don't. We could just flip it to a renovation loan. So make sure you, as the realtor, are asking a lot of questions of the lender, or, as the consumer, you're asking a lot of questions of the lender, just to make sure that really, is it something that can't be done, or is it something that they don't want to do or don't have the products for?
Awesome. That is great. Kind of jumping back to the appraisal, the appraisal side of things, Katie, another big question I get is commonly asked is, how do we handle situations when the appraisal comes in lower?
Yeah, so it's almost the reverse of the mortgage gap. So I'm doing the same things as I would when I'm giving people the opportunity to do an appraisal gap, but the appraisal has already happened. It's just come in lower than they originally anticipated. So obviously, best case scenario for my buyer, they negotiate the price down. That would be in a perfect world. Fantastic. Move on. Everyone closes. We're happy. Sometimes you have a seller who has a certain bottom line, or maybe they just have a certain price in mind and they're not willing to do that. I'll ask the buyer what they're comfortable with. And I always try to give them options in a range, right? So maybe if they're splitting the difference, sometimes can be a good range. What does the numbers look like for that? And if the seller doesn't want to sell any lower, then what are our options to finance as is? What changes on the terms? How much more money are they going to bring? What's their payment going to change by? And so that's a conversation I'm having with my buyer to make sure that they're comfortable with whatever we decide. But there are ways to save the deal, even with low appraisals and people being too stubborn. So know that if we tell you, listen, we can't change this, that they can't afford the terms, like this is the only way to get this approved, coming from me as a lender or Total Mortgage, probably, that's it. Like that's where we're at. So we're always trying to make everything work if we can, as long as everyone's happy.
Yeah, absolutely. That was great. Alicia, how do you handle self-employed borrowers?
Well, we try to get them to go with conventional regular financing first. But as I mentioned earlier, there are some specialty programs out there. So what's important with the self-employed borrower is how many years they've been self-employed. That's really the most important piece of it, because there's some financing with Freddie Mac that they can be just self-employed for as little as 1 year. If they've been self-employed for more than 5 years, we can use 1 year of their tax returns. Otherwise, generally, we need to do 2 year to look at 2 years of their tax returns. There are also programs for people who have been self-employed for less than 2 years, but the regular conventional Fannie Mae, Freddie Mac, they are looking for a minimum of 2 years of self-employment. with a self-employed borrower, we start by looking at their tax return and looking at their Schedule C, or looking at their business tax returns just to look at the income. And there are line items that we're allowed to add back to their income, such as business use of the home, such as and we have to take away meals and entertainment, but we can also add back other things. So it's a methodology that we use to come up with their income. And as I said, there are other programs such as the bank statement programs that will allow us not to look at the tax return. So say your self-employed borrower writes everything off because they don't want to pay Uncle Sam the taxes. We do have other programs such as the bank statement programs that look just at their deposits into their bank accounts, their
Yeah.
separate business bank accounts.
That's great. And this kind of will flow into this next question for you. What are options that you have that people that for your clients that don't typically qualify for your traditional type of mortgages?
So we would look at the DSCR mortgage for an investor. So an investor that doesn't want to have their own personal finances looked at. There's just based for the debt service loan is the principal, interest, taxes, and insurance, what the monthly mortgage payment will be. If the proposed rent, even for a single family home, it can be multifamily up to 8 units or plus with some programs, that if you have a minimum of 20% down, that we're looking at the how much income that property is able to bring in. And if it covers what the mortgage payment is, that works. The other non-traditional ways are we have the ITIN financing for people who are not U.S. citizens. We also have the bank statement financing. Those
Yeah,
are the three large ones. We have a whole other slew of them, but those are the ones that we generally will use. I mean, if we have to keep digging into our bag of tricks, we will. But those are the first ones that come to my head.
Yeah, no, that's great. We do definitely have a ton of options here for people that don't fit in the traditional. So if a client comes up to you as a realtor and kind of tells you their situation, always run it by us. I feel like we have so many options for all different situations. So that's great. So the next question is for Bree. And what is her timeline or your timeline for a loan approval / closing?
So we typically ask for 30 days to get everything done, from purchase and sale. From accepted offer even to closing. We are the takeover queens, it seems like these days. I'm sure all of you can attest to that. If I could tell you the number of loans I've taken over from other institutions that to this day, some of them I have no idea why they wouldn't close them. I've closed them in 10 days. I don't like to have to close loans in 10 days. Everyone's scrambling. But we do have the ability. So typically for approval, so just to kind of run you through the process real quick internally, we submit your file to the underwriter very early on in the process. And this is the reason why we're so big on making sure that we have a very complete pre-approval up front, meaning I've got all your pay stubs, W-2s, verifications of employment, asset statements, and everything. So when that file goes into underwriting, it's coming out with minimal conditions, which means we have a conditional approval. That doesn't necessarily mean we have commitment. Those are two different things. But we know that we've already had your file approved by the underwriter pending most likely appraisal, homeowners insurance, and maybe copies of deposit checks and proof that they cleared. So minimal conditions. So typically timeline for approval, our turnaround time will say 48 hours to get through underwriting. And when it gets really busy, maybe 72. Like our underwriters really kick butt as far as getting those loans in and out of the system. So, but hey, if you need us to get your loan closed in 21 days and that makes you the most competitive situation, we are going to do it. So
and we're going to nail it. I want to add to some banks, what they do is they won't do the next thing until the previous thing is done. And we do everything simultaneously. So we order title, we order the appraisal, we work on the approval. So you're not waiting for an approval before an appraisal's ordered or title's ordered. Like we're doing everything. And I do find a lot of competitors have started doing this because it makes so much more sense on time. But some of the old school banks, we're still seeing they have to wait for one thing to get to the next, and things are just getting delayed. Yeah. Legally, we can close in 7 days according to paperwork standards. And so if like on a takeover, Bree's closed loans in 7 days, taking it over from another client. making sure it meets the first closing date that I originally have. We want to keep it on track if we can for you guys.
Mhm.
And
Be a
so,
lot easier to start with us first, though, rather
yeah,
than
just
having
start with
us
us.
take.
So
My
much
agents all the
easier.
Start with
Yeah.
us, you don't have to go anywhere else, and you don't have to have the stress of having it taken over by someone else.
Yeah,
Yeah,
yeah.
no,
But we do love it.
exactly.
I always tell people don't realize this, and sorry to go off a little on a tangent because I know we're already over time and I appreciate everyone being patient with us. But when I talk to realtors, you'd be shocked at how many are like, oh man, I had a deal fall apart 2 weeks ago. It was such a bummer. I'm like, oh, did you have someone take a second look? And they say no. It's like, oh my gosh, no one is no one is going to be harmed by taking a second look. If
Right.
obviously if the buyer doesn't want to because they've lost a job or something, that's a different situation. But most buyers and sellers want to keep the deal together that's already going. It's
Right.
a lot easier. People have made arrangements, and things have already started transpiring. Get a second opinion. Whoever it is, like just obviously call us. That's a lot easier. But we're going to be able to tell you within 24 hours, yes, this looks like we're going to make it work, or nope, this never should have probably been approved, and there's no way I can get this to guys.
Right, exactly. So kind of piggybacking off of that type of question on how quickly we can close a loan, Kelly, is there any main factors that can cause some delays in a closing?
Funny you asked me this question today, that I have a closing that was supposed to happen today that is being delayed because it's a multifamily and there was a tenant that was supposed to vacate who didn't vacate over the weekend. So truthfully, what can delay a closing is so many different factors. I did a little bit of Google research as I got this question, and I actually learned that the number one delay in closing is title. So a title coming back not clean, an error with title, something like that. So that is the number one reason. That doesn't mean it's the attorney's fault, okay? Because people always like to place blame in why the closings get delayed. It's often no one's fault. It's just the transaction. But title is the number one reason. We also sometimes see delays closing, truthfully, for borrowers who are not providing paperwork in a timely manner. That's why, again, we like to collect things up front. That way we're not waiting for it, but occasionally it happens. We do sometimes see closings get delayed because an appraisal either came in low and now there's negotiations that have to happen, or an appraisal came in subject to repairs, meaning that the appraisal came in, maybe you came in at value, but there's a repair that needs to be made before closing. So that can delay closings. But truthfully, I think the biggest thing to know with a delayed closing is that as long as everybody has good communication, the realtors are on the same page, the lender, the client, it doesn't have to be the end of the world. Is it stressful? Yes. But it's something that we can often move through to get you to the other side. But I think, as the realtor, to not delay closing, the best thing is communication with your lender and the attorney. As the lender, our best thing to not delay closing is to make sure that we're always communicating anything that's happening in the file that's concerning with our realtor and referral partners. And as a buyer, it's get your paperwork to us on time and don't delay.
Love it. That's great. Those are all very, I guess, the most common factors in what can delay closings. Just a couple questions left. Bree, can you explain how mortgage insurance works? I think that's a big one that clients, I feel like, get almost nervous about, but don't really understand how it works and what goes into it. So if you could answer that, that'd be
Yeah,
awesome.
and mortgage insurance, also known as private mortgage insurance, not to be confused with homeowners insurance, because I think people think that might be similar. As a lender, we have the borrower is actually paying for mortgage insurance that actually protects the lender if the house were to go into foreclosure. So if you do not have 20% down on a conventional loan, it's a little different for each loan, you will pay an additional mortgage insurance that, depending on your credit score, is added to your monthly payment. There's also, like VA does not have monthly mortgage insurance, but there's an upfront mortgage insurance cost. Same thing, FHA has a monthly mortgage plus an upfront, and USDA has the same. So it really is insurance that will automatically come off if on conventional loans, when you reach 78% loan to value, which means you have 22% equity in the property, you do have the ability to ask for an appraisal within your process. You have to read your private mortgage insurance documentation at 20% equity in the property, 80% loan to value. But that is something that is typically mandatory on most conventional loans. Now, there are type of loans that there's no private mortgage insurance, buyer beware, because some lenders will do that, but it's added into your rate. So at the end of the day, just remember, most things aren't for free. But Mass Housing does have a product. There is no private mortgage insurance attached to it. It's the Workforce Advantage program that's, specific to that bond program, but there are similar programs in different, bond programs in states and things like that. You just have to ask the question, but the income limits are typically pretty low for those. But yeah, so private mortgage insurance is, unfortunately, something that you do have to pay for if you don't have sufficient equity in the property, but still allows you to buy that conventional home, that 5% down or 3% down.
Yeah.
And if you
And I
have
always
great
tell my-
credit, not
Yeah.
very